The economic outlook remains as uncertain as ever. However, there's more evidence that the lowest point in the recession was in May, despite the Victorian second wave. An update of our views as we enter spring. The second quarter GDP fall of 7% was, of course, a record contraction, at least since the 1930s. But even with the tight restrictions remaining in place for Victoria, the national economy is expected to expand in the fourth quarter after a fairly flat Q3. The impact of the restrictions on Victorian businesses is savage, as policymakers walk the line between managing the health crisis and reopening the economy. And even beyond Victoria, business and consumer confidence are being tested with borders remaining closed. The 7% contraction in the economy was in the end better than initially feared, and when compared to other comparable economies, a shallower recession, although that would give little comfort to impacted businesses and households. There's a clear correlation between getting the virus under control quickly and effectively and minimising the economic damage. The UK, Europe and US are scary examples of the converse, but all recessions are costly and painful. The post-pandemic economy will rely on getting health policy and fiscal policy right for a sustainable future, as well as supporting businesses and helping them to rapidly adapt to the tectonic shift in consumer behaviour. The low point in the jobs market, which collapsed in April, was early May by most measures, although the Victorian second wave continues to show the two-speed economy diverging. How this pans out in the months ahead will depend on how quickly the economy can be reopened in Victoria and, for the rest of Australia, also avoiding second waves and managing hotspots. One crucial part of this period ahead will be reopening borders, which will allow domestic tourism and trade to offset the complete absence of international tourism. Despite all these challenges and much worse conditions in most countries overseas, especially beyond Asia, the markets have regained lost ground. For the Aussie dollar, actually at a 2-year high, helped by the weak US dollar and strong commodity prices. And for the stock market, while we haven't kept up with the US, with their indices again hitting all-time record highs prior to the latest correction, the prospect of the RBA keeping the cash rate down close to zero for 2 years or more to come is encouraging investors into equities. And hope springs eternal for a vaccine, which the government have committed $1.7 billion to produce locally. That's a drop in the ocean compared to the $900 billion in total government debt we're forecast to hit next year. But that number still compares favourably to the rest of the world. And lastly, the residential property market is still under pressure in Sydney and Melbourne, but continues to trade strongly in regional Australia and is near fresh record highs in Canberra, Adelaide and Hobart. It's likely to be a tough period for property with lower demand from overseas migration, on top of high unemployment and the reliance on policy support. But that support, both monetary and fiscal, is still in place. And we'll hear more about it at the federal budget on October the 6th. And that's the market update from Bendigo Bank.